I think give bit of a warm up as well. Give about 10 minutes or so. I think we should be fine. I mean, half an hour for me is more than sufficient.
Okay.
Okay.
Even if we start at 5:15, I should be able to finish 5:45. Easy.
All right. Well, we're starting now, so
Hang on.
no warm up. We're getting right. Okay. Apparently, recording's in progress. I've put the 50p's in. So, folks, no more swearing now. Okay, we're not in the green room. We're going live. No more swearing. Okay. So, for all of you property investors out there, my name's Dill, obviously. We're here with the Property Professionals Weekly Show. And you may have seen in WhatsApp groups, there's been a flurry of stuff about taxation. So guess what? We had to call in an expert. And here he is. I'm not going to do him justice with an intro, because, you know, he's a regular guest, regular presenter here. I've had to get extra 50p's for him, so don't worry, I've got you. Now, the only way I can introduce our next guest is to say, basically, he has more letters behind his name than the Russian alphabet. That's it, and he knows his stuff. So, Arif, I'm going to do something really hard for me, which is to try and stay quiet and hold my questions till the end. So I'm going to pass it over to you. Look, welcome, Arif, from Matplus Accounting. He's got a bunch of letters after his name. He's got a bunch of qualifications, and he's going to talk to us about our favorite subject, as they say. And it's not death. So, you know, the only two things certain in life, in this country, is death and taxes. He's going to talk about the second one. Over to you, Arif. I'm going to try and stay quiet.
Thank you so much, Dil. Before you go, could you just allow the share screen so I can perhaps share my screen as well?
Oh, you mean you want me to spend even more of my 50p's? Oh,
Please,
I should have guessed that question, shouldn't I? I mean, you know, that was my favorite question. I'm losing psychic abilities. Have a go. See if you can do it now.
Yeah, should be fine. Yeah, there you go. Can we
Happy
all
day.
view the slides?
Right. I'll try and stay quiet now if I can. Might be hard.
Brilliant.
Off you go, sir.
Well, thank you very much for the property professionals, and it's always an honor and privilege to be part and giving me the opportunity to speak at this event. And today we will be talking on to the property tax planning in crisis, and there's a much happening, isn't it, in the taxation world, especially around the property sector itself, at least in the last few more weeks or more, with the invent of a tax think tank called Tax Policy Associates, and perhaps the HMRC confirmation as well onto one of the tax anti-avoidance scheme. But we'll discuss that part later. And today's topic will be what the taxman doesn't want you to know. So at the end of it, we would try and take some nuggets, if we can say, which we potentially could be using it to mitigate our taxes going forward. But yes, I'm Arif Punjani, and these are the letters that I have behind my name because I have earned that by having those qualifications. But before I go for that, and before I uncover the property tax planning, given, as I've mentioned, the current climate onto the tax policies and the tax avoidance scheme that have been going around, arguably, it's important that we understand before we seek any tax advice, whether it's myself or any other firm for that matter, it's very, very important that you take these three key checklists, and they are very crucial. The first and foremost would be the fact that the person who we're taking the advice from has to be a qualified professional. There have been numerous unqualified professionals roaming around in the market, and they have not even heard about the qualification, let alone having the qualification to begin with. So it's important that you have them, because God forbid, if something were to go wrong and you have been advised ill, you could refer them back to their professional body. So they would have something to lose. Indemnity insurance, irrespective of the fact that the person has got a professional qualification, at times, even if the person could be at fault because of ill advice, you can't do anything about it. So indemnity insurance, as much as sounds like, yeah, the person has got the insurance, you can claim on it, it's not that simple, but at least that's the last resort, which really you don't want to go for that. And last but not the least, and this is what I would say as a thorough advice, which is advice given in writing, backed up with the legislation. So you would avoid he says and she says. It's a fact of, yes, that's what the advice is based on, say, for example, TCGA, which is Taxation of Capital Gains Tax 1992. I believe as far as you tick these three boxes, you're mostly covered and largely covered with the advice that you've been given is more or less appropriate. Now, there are some QR codes that is highlighting towards the and highlighting onto the fact of the last 1 month or so, the tax avoidance scheme that has been ongoing. One of them has already been recognized and understood by HMRC, stating, yes, it is avoidance, please don't go there, which is a mixed LLP partnership, which is a hybrid partnership as well. But others are also getting evaluated as we speak. Now, my introduction, what allows me to speak onto the property taxation side of it. Firstly, onto my qualification. That's me, by the way, 20 years ago. Used to be handsome, but not now anymore. But hey ho for that. Yeah, I qualified originally from the Oxford Brookes, and thereon I became an ACCA member, to whom I'm no longer a member now, because I'm already a member of so many other profession bodies. I'm a member of Society of Trust and Estate Practitioner, which specializes into the trust, inheritance tax, estate, and will planning. I'm also a member of Institute of Chartered Accountants of England and Wales, and I'm quite honored and privileged to be a member of that. Thereafter, I became a member of ATT, which is a body for Association of Taxation Technician, and as we speak, I also sit at the ATT's VAT board, consulting side of it. I'm also a member of Institute of Chartered Institute of Public and Finance Accounting, that is in line with the accounting for the public financing side of it. And lastly, the Personal Finance Society as well. Over and above, I also act as a professional trustee for many family-run trusts that we run and that we form and assist and advise clients on. But over and above and beyond, and most importantly, I always mention the fact that I'm also a property investor and a landlord. So as much as I could empathize from the a taxpayer's point of view, I can also empathize from an advisor's point of view as well. So I have that two particular viewpoint to look into. When I look at my own tax affairs, yes, taxes have been changed recently as a result of continuous bombarding of HMRC to us. And presentation would uncover as to what those bombardings are, what do we do to protect ourselves against. So before I go for the presentation, let's look at the current climate. Bank of England base rates, same time last year, were rosy days. Not this year. Currently is 5.25 as of now, and the chances of going down back to what it was before a year ago are highly unlikely, at least for the next 1 year. But again, they're all predictions and forecasting around it, and no one can be certain about anything for that matter, except the Bank of England Chancellor themselves, or perhaps the Exchequer themselves would not be able to predict that far along. But it's safe to say that it's going to be there for some time. With that, we are living in the Europe's highest inflated country, as it is as we speak, as per the Financial Times. So yeah, things have been difficult. We have seen the property prices definitely not going up and remain stagnated, at least if not gone down, depending on the area of the country that you live in. Section 21, which is linked to the tenant eviction, has already been amended. And that has been linked into the fact that now that's making landlords' life even more difficult to evict the tenants, those who are not paying on time. And as if this was not sufficient, Section 24, which has been there since the last 5 years, which limits our ability to deduct the mortgage cost from the property rental income. So on one hand, we cannot deduct the mortgage cost because of Section 24. On the other hand, the mortgage cost itself has gone up. So while I'm paying more than double at times, I'm not been allowed to deduct the mortgage cost. What the worst can happen. But hey ho for that. We'll uncover some of the good news, hopefully, and it will come for those who wait. Council licensing, many councils and many boroughs are considering perhaps introducing licensing for room-by-room basis for HMOs as well. And God forbid, if that were to come, it would really make running and management of the HMO challenging for profit-making purpose. But these are just some of the highlights that we are currently facing as of now. That's outside the taxation side of it. What are we trying to cover in this particular presentation? Is what are the property taxes. We are all landlords and property entrepreneurs and investor, but often we don't exactly know what the property taxes are as far as the UK residential or commercial property is concerned, and throughout our journey, what we expect to encounter those taxes. Why we need property tax planning, as in if I were to be in the, say, a manufacturing or a fashion industry, as opposed to a property industry, why do I have to be more savvy around doing the tax planning as compared to any other industry? Purely because HMRC is penalizing us and considering us a cash cow for collecting revenue more easily and frequently. And last but not the least, as I've mentioned, it would come for those who wait, will be how we save property taxes. I like to give the examples and a parable of a normal human life when it comes to anything that I would like to explain or understand for myself as well, as a matter of fact. So what I have done is considered a tax life cycle of a UK property and divided into 4 parts, such as a human part, as in when we are born, we are baby, we reach our youth, then we reach maturity, eventually old age, and then we die. Something similar happens into the property sector as well, as even effectively to get into the property sector, we have to buy a property. Then after buying a property, we could potentially earn something from that particular property. Not necessarily we have to. We could sell the property, and then we may as well keep and then eventually die with that particular property. At each of these 4 stages, we are encountering different levels of taxes. And these are just the minimum. Of course, there are over and above other taxes as well, which I would not complicate the matter now, but just to give you a holistic view of what the taxes could be and why it differentiates our businesses from the other businesses is the fact that, as I'm highlighting, the first and the last one, which is stamp duty, land tax, and the inheritance tax. Now, I always give this typical example of a pen, that if I were to buy a pen, would I pay a tax on buying it? Some would say yes, you could be paying a value-added tax, which is VAT otherwise called, but VAT is actually a tax on the end consumer, not for a business person like me. Because if I'm paying VAT on it, I would eventually claim the VAT back from my sale invoice as well, from my customer. However, in essence, other than the VAT aspect, I'm not paying any tax because it goes against the fundamental principle of taxation, as in the fact that you would pay a tax, especially a direct tax, as long as you have earned something from it. Now, when it comes to stamp duty, land tax, you haven't paid anything. You haven't earned anything. Why should I be paying a tax to begin with? I've just bought a property. That means I've incurred an expenditure. But that's contradictory to any industry. As I've mentioned, in our industry, we pay tax when we buy a property. At the same time, if I were to convert this prop pen into, say, a 10 million pound business and then eventually die, the entire business could be subject to business property relief and no inheritance tax could be payable on it because it's a trading business. However, if I were to replace that 10 million pound business with bulk of properties, which are residential or could be commercial for that matter, the entire business could be subject to now inheritance tax at 40 chunky percentage. Why? Because the legislation specifically excludes any businesses which involves bricks and mortar, and that is our business. And in addition to it, at other stages as well, I would see, and we would go through with the transition of what tax changes have occurred in the last 5 to 6 years among the lines of all these different 4 types of taxes. So let's go with an example of the fact that, say, someone bought a property for, say, £100,000, did a refurbishment of 50, and now the market value is 200k. Hey ho, I've made a profit of 50, but that's your profit. Is that what you've taken home? Would you be not fascinated to know as to how much you've taken home? Well, you have surely paid at least £3,000 worth of stamp duty, land tax and £14,000 of capital gains tax if you were to sell the property. So that means if you sell, you have to pay £17,000 worth of taxes. That's 1/3 of your hard-earned profit. So yes, you can take home, but 2/3 of it, 66% only. 1/3 has been taken by HMRC based weekly. That's a huge figure. And as if this was not sufficient, if you were to keep it and die with this particular property, you're going to pay inheritance tax at 40%, which is 2/5, £20,000. That's high sum. And that is only up to now. If the property price were to go up, this 40% could only go up and not go down. So we are talking about some serious figures here that could impact our bottom line and eventually our pocket, and to see as to what can be done to mitigate them. What we are going to do now, as we have gone through with what are the property taxes, we'll just look into what changes have occurred in terms of legislation wise in the last 6 to 7 years on those 4 taxes only. Let's start with the stamp duty. Land tax, there was a surcharge that was introduced back in 1st of April 2016, and that was saying, oh, you are paying on buying a property, which as it is was unfair. Never mind, just pay 3% more. Well, that's what in a lethal way and a crude way, what HMRC legislation used to say. And that's what it is in essence. As a result, what happens is, if a property worth £125,000 that you're buying, this is the additional tax, by the way. That's not the actual stamp duty land tax. What you're paying additional to what we used to pay before. So what you're paying now is 3,750 more than what you could have paid on property value worth £125,000. Same goes to property value up to 250. You're paying £7,500 more, and so on and so forth as the time passes. So if I were to go back to my previous example of buying and selling a property after doing the refurbishment, which is called flipping in the property industry terminology, I would have made more profit because surely I would have paid lesser than 3% stamp duty land tax had it been the same business I was doing it pre-2016 rather than post-2016. And we are all in post-2016, whether we like it or not. And as if this was not sufficient enough, the legislation further changed on March 2019, stating that you have to pay now STLT within 14 days as opposed to 30 days, as if HMRC could not wait for 16 more days. But that's the sad story of cash collection from HMRC as far as properties are concerned. And really, it is a cash cow when it comes to the properties on property taxation. Some nuggets in terms of stamp duty land tax would be the fact that not many of us would be knowing that if you were to buy a probate property, you could be paying almost zero stamp duty land tax. And that's a huge, huge tax savings. If you were to look at it from a stamp duty land tax point of view, if you were to buy a property worth £1 million or maybe more than that, do the math in terms of STLT savings you would do. And likewise, there are about 27 other STLT savings that are available in the market that you could be using it, but making sure that some of them are only advisable when you do pre-transaction rather than post-transactions. We'll go on to the capital gains tax post. The legislation changed in April 2017. What does it say? Is that if I were to buy this pen and sell it, it turns out to be an antique. If I've sold it, the capital gains tax on this would be 10%. But if it happens to be residential property, no, you have to pay 18%. A clear bias to residential property. And of course, if my income were to be higher, and if I'm paying more than 50K as an income, then my capital gains tax will be 28% as opposed to 20%. Now, there's also further changes in the capital gains tax, not just into the property sector, but across the board, is the reduction of the annual exemption. And that annual exemption means up to what amount I will be paying capital gains tax. So before it was in the range of £12,000, that is now reduced to £6,000 in the current year. It will be reducing further to £3,000 in the next year. That means any gain that I would make, only the first £3,000 is subject to no capital gains tax. Then thereafter, I'll be paying immediately capital gains tax of 18 or 28%. So lower the threshold, higher the tax that I'll be paying on, of course. Section 24, and I believe no other legislation has created the amount of hoo-ha as much as this particular legislation has created in our industry. And it clearly states, which requires no rocket science brain to compute the fact that it clearly says you can no longer deduct any finance cost associated with buying your particular property, as in whether it's a loan or mortgage for that matter. Now, that introduced from 2017-18 onwards up until now in a phased manner, whereby it got reduced from 75%. It's in the fact that, yeah, you can deduct only 75% and then only 50 and then only 25. Up until now, you can deduct 0%. So clearly, as of now, as we speak, you can no longer deduct the mortgage cost from your rental income. And yes, that means increase in profit, that means increase in tax, that means do something about it, obviously. But what if I were to say that Section 24 does not affect each and every individual? And what I meant by that is if your total income were to be in the range of about, say, 50K, give or take, ballpark figure, then you are not affected by Section 24. That means you can still deduct the mortgage cost from your property rental income. You would only be affected if your rental income, including any other income, were to go above 50K. And I'll prove you with the example. Yeah, I have not had anything to drink before coming to this presentation, so relax. So on the left-hand side here, you have the basic rate taxpayer, where the income is up to 50K, and somebody whose income is above 50K. For the purpose of consistency, I've just multiplied both the figures with the rationale of number 2. So if the rental income is 40K, I've multiplied that by 2 to make it 80K, and so on and so forth. So goes for the mortgage interest cost, £10,000 to £20,000. Now before means before Section 24. So before I could deduct the mortgage cost, and hence my profit was 30K. But after, I could not deduct the mortgage cost, and hence my profits are 40K itself. No mortgage cost could be deducted. Same goes on after on higher taxpayer as well. Now this is where the magic happens. That means the income tax I used to pay 3,486. Now I'm going to pay 5,486 because of course my profit has gone up. But the last but not magic in the entire attention to detail would be the relief that has been given at the basic rate band. What it means is that HMRC is saying that what you could not deduct earlier, which is £10,000 worth of your mortgage cost, we are giving you a 20% reduction as £2,000 to be deducted from your final tax liability. That means my basic rate taxpayer status would remain the same irrespective of whether they allow me to deduct the mortgage cost or not. It only affects when I become a higher taxpayer, as in my total income were to go above 50K. So that's an example live with the figures in front of you. Now the last but not the least, and one of my favorites one, which is inheritance tax. Every year as the time changes and as we go into more and more advanced centuries ahead of it, there's something called retail price index or consumer price index or inflation. With that, every year it keeps on improving and increasing so that it has to match up to the current inflation rate. What I meant by that is income tax band, a threshold, back in 2009-10 was 6,475. So that means up to 6,475 I would not pay any tax. Anything thereafter I start paying tax. That has increased in the year current, which is 12,570. So only up to this much amount now I would not pay any tax, because it would be unfair to get this amount frozen. As apart from the cost of living that we currently face as it is as of now, what is important is the overall cost of inflation has gone up. The inflation, as it goes up, they have to increase the threshold so that the income tax that you pay aligns with the threshold, aligns with the inflation rate, and aligns with the consumer price index. Same goes for the NIC. It was before 5,720 back in 2009, and it is now £9,500. Now let's look at the inheritance tax. It was £325,000 back then. It is £325,000 till now. It was, that means, of course, 0% difference. And not only that, till 2022-23, it would remain up until 27-28. It's been confirmed. So it would remain for the next 5 years the same inheritance tax threshold. The tax rate, 40%. Chunky figure. Now again, go back to my previous example of buying and selling a property. That's flipping property in our industry name. The profit that you have made after paying tax, which is 2/3 of a profit, this inheritance tax going to hinge onto it for taking further 40% out of that 2/3 of your profit. So remember £17,000 tax that we paid already, and remaining with us was £33,000. Well, be prepared to pay 40% on the £33,000 as well if you were to die and don't do anything about it. That's how lethal it is. Let me give you the example of a live case study. And all I've taken is just humble zone 1 and zone 4 properties. And feel free to Google search it. They are available on Zooplus. The property value back in 2009 and what the property value now in 2022. What the increment the property has seen And as a result, what the inheritance tax liability would be on these properties if no inheritance, if no IHT planning has been done. Half 545,000 pound on zone 1 property and 272,000 pound on zone 4 property. Now these are huge figures. I mean 40%, we are talking almost half the value of your estate would be going to HMRC if you don't do anything about it. Now before I conclude this particular presentation, as I've mentioned, we would go on to looking at what we can do to mitigate the taxes. And I clearly believe in the fact that one size does not fit all, especially, and I will keep on saying especially up until the time we all understand, because the amount of tax avoidance scheme that has been sold across the market is immense. Because no one person's circumstance could be similar to another person's circumstance, and hence the tax advice could only be given looking at your own circumstance, which has to be tailor-made. It cannot be something which has been sold as on the shelf. Now let me share by giving another slide. Just bear with me. Yeah, there we are. Let me put this allowed to share the screen.
I might have to put more 50p's in.
No, you're fine. Can we view the screen now?
Yeah.
Brilliant. Okay, so I'll just roughly go through with about 6 effective tax planning measures and strategies that can be used in our industry. But as I've mentioned, please take caution and professional tax advice before you implement any of it. It's not there for us to do a DIY, and do not take any tax advisory unless, as I've mentioned, those 3 boxes have been ticked up. As part of the property portfolio corporation, as much as some of these have been sold
Arif, I think you're going to have to put 50p's in your Wi-Fi. Someone's lost their 50p's, I think.
not more managing those businesses.
Sorry, Arif, you broke up a bit. Could you repeat that last couple of minutes?
So what I've mentioned is the fact that you could do a property portfolio incorporation, which is transferring the properties from individual into a company name for the obvious reasons and the benefits, which I'll discuss it later. But the paramount and some of the criteria to do so is that you're spending at least 20 hours, if not more, to manage and run those properties as a business. Now, it can be argumentative whether you're spending 20 hours or not in the business to run those properties and to manage those properties, but the onus is clearly on and completely on the taxpayer. Once you have done that and classified that as a business, then you can transfer them into a company. Again, of course, the devil is always there in the detail, and there are always detailed legislation affecting it, but we'll explore that part later on if someone were to ask for the advisory services later. But the benefits of doing it is purely, number one, is the income tax, because under company you can deduct the mortgage cost, under individual you can no longer deduct the mortgage cost. But again, remember, even if you were to have 5 properties and your combined property rental income is less than 50K and you have no other income, go back to my previous example, and property incorporation would not benefit you for the interest cost, the section 24, because section 24 is not affecting you, remember that. So first advantage is section 24. Second advantage is the capital gains tax benefit. That's a clear advantage. How it works is that when you have transferred properties into company name, now all those properties have been enveloped into a share that has been issued against by the company. And hence, if you were to, for example, have 10 properties worth 100K each that you bought, and now they're all worth $500,000. If you decide to sell one of them, you would pay 0 capital gains tax, because you would only pay capital gains tax when you sell shares. You are not selling the shares, you're selling properties after incorporating them into company, and hence you're benefiting from it. Last but not the least, you can also do the inheritance tax by using a family investment company, otherwise known as a freezer share or smart company by some other laymeans. But coming to the family investment company, what in essence it does is when you transfer properties into company name, or perhaps when you have property into the company name at the outset, what it does in essence is that it freezes the value, provided you have a hurdle in place. So in essence, what happens here is you could have a property portfolio business worth say £3 million as an equity in the property. You're saying this £3 million I'm happy to pay inheritance tax on, but anything in terms of upliftment or growth according to that particular £3 million, I'm not happy to pay. I'm not prepared to pay inheritance tax on. And that's what the growth you're transferring into Class B shares. However, the growth that you have transferred cannot be valued zero. So it's very, very important that you have to value at least 10% to the growth shares. And then those 10% will still form part of inheritance tax. Anything more than that would not be, which unfortunately many other cowboy tax advisors are not doing the computation of the hurdle. And hence, if you have gone ahead with the freezer share structure, HMRC could be coming back to you for that 10% or 20% of the hurdle that you haven't computed appropriately on. But again, I suppose that's another matter. UK trust, and there is around so much of creative, perhaps tax planning or very close to tax avoidance that's been sold on the market. But what has not been done is using simple UK trust tax planning to settle some of your shares or some of your properties into trust. Now, it can be UK trust. You don't have to go anywhere fancy offshore, BVI or Cayman Island, and I would not recommend that. And the benefit associated with that is as soon as you put anything into the trust, from the day you have put that in, and you live 4-7 years from there on, standard UK legislation, you save completely all the inheritance tax associated with that particular settlement that you've put into trust. Not only that, if you're smart enough, you could also save income tax completely. So forget about the mortgage cost in Section 24 restriction, which company would you can deduct, but you have to still pay corporation tax. Here, you do not have to pay income tax at all, and I mean it each and every word of mine, with all my qualifications online for it, for that matter. Provided you are savvy enough as to whom you're giving the dividend from the benefit from the trust is. So if you're giving the dividend to somebody who's got no UK income, HMRC will refund the entire tax suffered by the trust to that particular beneficiary. And there is nothing stopping you to select overseas beneficiaries. It's not anti-avoidance, and HMRC is clearly absolutely happy with it, because majority of the time we create discretionary trust and everything is at the discretion of the trustee anyway. Group structure, which has been again quite popular but not being used as often as should be. Typically what happens is, instead of having one particular property, one particular company rather, and then you could have 10 properties within that particular company. And what that particular company does is collecting rent, repairs, gas safe, so on and so forth, and everything goes under the same company. You segregate the day-to-day management and running of the company to another company. So that company, another company will be an operating company, and your main company will be a property company. Your property company would do nothing but just holding the properties. So it's called PropCo, property company. It just holds the properties. And your another company will do the operating side, which is regular maintenance, collection of rent, gas safe, and so on and so forth. The benefit of that would be, God forbid, if you forget to do a gas safe on one of the property and there happens to be a fire and tenants died, they would sue on the company. Now, if there were to be no operating company, it would go onto the property company. Now, that property company not only has that property which has been now burned down, but 9 other properties as well, which the tenants can put their hands into. If you were to have the operating company, then they could sue only operating company. Now, operating company has got no assets. It purely runs as an estate agent business, which is collecting rent and passing the rent to the property company. But again, property company has given the operating company a long lease. So if the market rent of the property were to be, say, £100, it has given kind of a rent guarantee scheme to the operating company to collect the rent for 85% of it. So the risk has been passed over to all the operating company. So property company, by sitting here, will sweetly collect only 85% of the market rent and let operating company do all the headaches of property management and so on and so forth. And then any associated liabilities with it as well. And with that, the benefit is that of course, if you claim the VAT on repairs and maintenance, property company can never do that because it collects the rent. So it's against the VAT legislation of registering for VAT. So that's on to the property operating company, proper corporate structure. Let's go with the next slide, potentially the last one. Inter-spouse tax planning, as much as sounds so basic, we have seen many times and occasions not being used effectively to the extent should have been used. What I meant by that is one of the spouse is a higher rate taxpayer, as in the income is more than 50K, and the another one who's got income no or perhaps less than 50K. In that case, purely, and if the property normally happens to have under the husband name or the person who's got higher rate taxpayer, simply by doing a deed of declaration, you're transferring the properties between your husband to wife and vice versa. And there is no capital gains tax because the transfer between husband and wife happens at no gain, no loss. So you're mostly covered. You are sharing that particular part of rental income to your wife, and your wife has got no income, then you're saving as much as 45% on income tax by just giving their income to your wife. And even if your wife were to have a basic rate taxpayer, you're still saving 20% or 25% depending on your status. Property management company. Now, again, this is kind of a no-brainer tax planning, irrespective of the fact that whether you have 10 properties or 1 or 1,000, and whether you're completely okay with it, you can go back to and refer the legislation which has been given, confirms no anti-avoidance, provided you give 15% of your total property rental income to a company. It's acceptable by HMRC to have that as a property management. That means if you're a higher taxpayer and if you're paying 45% tax, you transfer 15% of your total rental income into a company, and that particular company would sweetly pay only 19 to maximum 25%, and hopefully only 19%, because then that way you have saved at least 15% of your total rental income subject to higher rate. You are now going to pay higher rate, but only on the remaining 85%, which you can work something out around. So that's property management company. Again, it's a given. Using children and family member, we have already covered about the spouse side, but often we don't normally see using children within the property business management business, and they do take part in the property management business as well in terms of day-to-day running of the property. The minimum age in this country to work, as much as we would all love to know, and I've got always get guesses of 18 to 16 to as low as 15, but the actual minimum living age to work in this country is 13. So if you have as low as 13 years of kids in your family, they could be working in the business, and it's a good way to perhaps give them experience as well, a hands-on real-time business experience. At the same time, they go onto the payroll, they get remunerated, and business saves 45% if you hire a taxpayer to a minimum of at least 40 to 20%, because with children up to 18 years of age, not only pay no income tax on the first 12,500 which you're going to give, but also doesn't pay any national insurance as well. So these are huge savings to be worth considered. And last but not the least, something which you can do in terms of tax planning, which is we have discussed as in what you can do to pay lesser before actually having the transaction to occur. Now, there are some instances where the transactions have already occurred, but now what you can do to get the tax back. Stamp duty land tax is one of them. And I've given you the example of a probate property as previously I've mentioned. There are some other reliefs such as multiple dwellings. So if you're buying 5 or more properties at the same time, then the rate of stamp duty land tax goes down significantly. And you can play around with the fact that no, you can buy all the 5 properties exchange at the same time. There's something also called granny relief, whereby if you're buying usually, well, if I were to just put a benchmark figure in London, I would say perhaps a property worth £1 million, and it has to be a detached property. It usually would have a building attached to, which is, you would say attached to, but not an attached to, kind of an outbuilding or a granny house. And there you could segregate the both the properties and get a reduced stamp duty land tax on it. Again, all of these are something that you can claim even after paying the stamp duty land tax. So you might have paid stamp duty land tax, but now you've realized, oh, I could be receiving a refund on it. We are happy to review your circumstance and your transactions. And if you are eligible to get the refund, we'll be working on the no-win, no-fee basis to get your tax refunds back. And I'll put you back to my previous screen to share the last but not the least contact us details, if I may. And yeah, that is all from my side. Dale, thank you so much for bearing to listen to me again today and giving me the opportunity, and happy to answer any questions that you guys may have. If you scan the QR code, you will also get the 7 Smart Tax Planning Strategies, a mini booklet that we have created that will be sending it to you once we have the details. But yeah, fire on with any questions. If I could know, if I have the answer, I may be obliged to give you the answer there.
So scan the code, get your free 7 smart strategies of tax saving. Secret 7 smart strategies of tax saving, right? That's a very good presentation. It's been a while since I've seen one of yours. It's really interesting now. So just to touch back, you can do a reclaim for stamp duty that they may have paid. And probate is
in terms of reclaim, what I have not touched others is the land indemnification relief as well, and the capital allowance. Now, capital allowance mostly goes against corporation tax, so it's not really a reclaim, but you are reclaiming it. So you are reclaiming it, but capital allowance only occurs in commercial property, and stamp duty, land tax is irrespective whether residential or commercial.
Yep. Okay. Good stuff. And we touched earlier, and we were talking about it just before the program. There's a lot going on WhatsApp groups about, there was should we say, some schemes that have been now classified as anti-avoidance.
Yeah, so I mean, as it is, when it was been introduced, and we obviously have come across some of these cases as well, which has been confirmed thoroughly by HMRC, and I would only comment on one of the QR codes that I have shared. It has got one of the link to HMRC, which HMRC confirms these are called hybrid LLP. So I'll give you the example of what hybrid LLP is, and you should be making sure that you are A, not going into it, but B, if you have gone into it, you have to seek seriously a professional tax advice to make sure that you make your affairs in order. What usually happens with the hybrid LLP, which again was nonsense, but I'll give you the example of it. Say I own a property. Say I own 3 properties under my name, and I'm paying, and I'm also happens to be a GP. So my income is over 100K, and obviously on these property income, I'm paying 40% or 45%, and I'm not getting mortgage cost deducted. So what I decided to do as a smart way is I form a company, and now there's a partnership between myself and that company. Now, company is owned by me as well, and I myself, of course, I own myself as well. So now there's a partnership, which is an LLP between that company and myself. And the beauty of this hybrid LLP is the fact that once I have done the computation of the partnership income, which is all the 3 properties now goes into partnership, the distribution of the rental income is completely at discretion of mine and the LLP. So I would normally give as much as possible to the company, because company will pay 19% corporation tax opposed to me paying 40% tax. And depending on what my current circumstance would be, I would pay myself limited or none, and company would pay the 19% corporation tax, and thereafter what is left over, I can withdraw it as a dividend, or will keep it as it is. That's what it used to do. That's the basic side of it. Now it goes a bit more in detail as well as to what others were doing it, but as you could see, there is no real partnership here. I mean, all 3 people are just nothing but me, myself, my own company, and LLP, which is me. So it's a nonsense. I mean, forget
me, myself, and I, right?
It is me, myself, and I. And actually, it is me, myself, and I, where the 3 partnerships have been formed as in 3 musketeers, and there are some other 3 musketeers as well, but we'll not go there. But that's the basics of LLP. It goes a bit more in detail, whereby it would give you the all the good tidings of you don't pay any inheritance tax, you don't pay any capital gains tax, and you have to also understand there is no magic wand that will save all your taxes overnight. And if anything which is sounding too good to be true, often it is not true.
Yeah.
But again, as I mentioned, once you tick those 3 check boxes, and if I were to say, and even if someone were to say, yes, you should be able to go ahead with hybrid LLP, as long as they can back it up with the legislation is fine. But again, you don't need even a taxation brain to understand the fact that there's something wrong here. Company is mine, I myself mine, and the LLP, there are 2 partners to LLP. One is my company, which is owned by me, and one is me. So how there could be a partnership to begin with? But that has been given a seal by HMRC. Don't go for it. We don't approve it. And if you have used it, make sure you correct it. And
Okay.
as it is, as we speak, there are at least 500 or more LLPs flipping around into the company's house website, and even more, which we're
So
not aware of.
have they currently said don't use it and rectify what you've done, or have they said we're coming after you guys and you're going to get fines?
So hybrid LLP, the legislation is already there. The announcement is already there. So of course, if HMRC is saying that we do not recognize this, goes without saying don't use it, because HMRC doesn't recognize it. And if you have used it, so it's more for the prevention rather than the cure, as I could strongly, like, I fail to understand what the cure could be, except the fact that put yourself back to what the previous situation was, which means going back to what you earlier paying in terms of income tax. And not only the fact that if I have done this LLP structure, this nonsense LLP structure, say 4 years or 7 years ago or 6 years ago, then HMRC would say, okay, what taxes you should be paying since the last 6 years or 7 years? You pay that first, plus you pay the interest because you not paid that, plus you pay the surcharges, and plus you pay the penalties. So if you add the interest, surcharge, and penalty, these are all 3 musketeers of HMRC as well. Often than not, your tax liability, if it happens to be £1,000, when you add these 3 up, it also happens to be £1,000 as well.
Now you've just doubled your tax liability.
So that's why I would that a good HMRC inspector with nice tie would come to see you, because then they would have something to collect from. Otherwise, they're only wasting your time and their time as well. So it's mostly associated with that. Not only that, now of course you've paid your taxes under companies and the corporation tax. Now getting that tax back from HMRC in terms of corporation tax is also another ballgame altogether. But it's for those who have gone through with those tax advisories. And as much as I would empathize with them, there's also an element of greed whereby they could see, yes, yeah, we could save taxes, why not? But you also, then when the greed overtakes your normal common sense and the brain, that it doesn't require, like I said, a specialist to understand there's something going on here, something which is obviously wrong. But if you have still gone for it, then all I could say is best of luck.
Okay, now just to clarify, that is just a deliverance on the, how would you put it, the self-owned LLP route. You're not, it's not saying that you can't put a property into a partnership and then transition it into a limited company. That's
of course
still
not. Of course not. You can put it, but there has to be a genuine partnership. And the questions have been arose onto another organization where the questions has been asked, where they've been doing it. They've been doing transferring properties into partnership, and then keeping partnership for 3 years. You have to, and then after putting them into company. However, the way they were doing it was incorrect, whereby majority of the time these property would be subject to mortgages.
Okay.
The way they were doing is that you could do the completion, you could do the exchange, but the completion will be delayed. So that means you don't have to notify the mortgage lenders. So in essence, if you were to look at it, I have 5 properties, and today I have transferred them into company name on book, on paper. Mortgage brokers do not, the lenders are not aware of it. But that's again another matter. I'm not bothered about lenders as well, although that could be not in line with the lenders' terms and conditions, and I could be breaking their laws. That's separate matter. Let me just concentrate on the taxation itself. It says that I have transferred all the properties now under company name by using a trust. And if I have done so, then all these properties, the computation of rental income will go under company name. But in essence, the company is not owning those properties. I'm still owning those properties. So what does company own in essence? The company does not have the title deed, and the company does not even have the mortgage under the name. So the entire transfer could be subject to question. And if the transfer is subject to question, and if the transfer is not appropriate, then the capital gains tax and stamp duty land tax can also be subject to question. And it's a serious matter. And I've been repeatedly telling to everyone. It's like giving a quick an opportunity to do a detailed heart surgery on your body.
Yeah.
It's in fact even as grave as that, because majority of the time transferring properties into a company name, which is your entire portfolio, could be your life saving, could be something that you are heavily reliant on and dependent on. So doing that, and if HM asks you to question stating we don't consider this to be a transfer, then all of a sudden there are different worms that would come out as well. But again, so it wasn't completely wrong from that perspective. It wasn't as nonsense as, me, myself, and I, but it was nonsense to a large extent of the fact that, oh, you're transferring into company name, but company doesn't own the properties, and company doesn't own the mortgage as well.
Yeah. So
the lenders do not know that it's been now transferred into company name.
Right. So they've tried to be too clever, I'm guessing, right?
It was I would say, if I were to be very lenient, I would say it was very aggressive tax plan.
Mm-hmm.
And normally when the word aggressive has been used, it puts you down into the avoidance scheme. But that's again debatable. What was other structure that they had come up with is the fact that before incorporation, the company would take a loan, a bridging loan for a day, and then the directors would be paying that back, so that in future the directors withdraw any funds from the company will be subject to zero dividend tax. Now that's a clear avoidance. Not even I won't go even avoidance here. That goes into a separate level of, which I don't want to use the word here. But yeah, that's a clear no. So that's been given.
Right. I'm afraid to say you're definitely going beyond my level here. So it really is interesting, and thank you for shedding some light in this painful topic, I'd say, but painful more than one way. Please put your scan code back up, and we'll close that out. So please look.
Okay.
I'm really glad you produced that booklet, and you've made it so simple that anyone can use it. Well, anyone who can use a scan code, they're quite good. So please get that little booklet. Thank you, Arif, for doing that. Thank you for presenting it. And I'm loving the new presentation. It's really interesting. I love whoever's doing your slides, give them a house point, because some of those illustrations are pure magic.
Thank you, Dave. I'll pass your message.
Sorry?
I'll pass your message.
Yeah.
And thank you so much for...
Thank you very much for sharing one of your most valuable assets, which is your time. And to all our viewers, look, thank you for your attention. Please watch this again. The recordings are available. Get Arif's magic booklet, The Secrets of 7 Smart Tax Planning Strategies. Right, the 7 secret strategies of okay. Brilliant. No, that's really great. I'm loving the S and the 7 theme there. And literally, do things the right way. Don't do them the wrong way, as Arif would say. And less of me, myself, and I, and more of put your power team together with a decent tax person. No commission being entered into here. And the reason I say that, not because I'm asking for any, we did an interview with Lord Lytton, and I said, I sort of said, he's a man in the House of Lords, and he said, no, I'm not your man, because I just realized you might get in trouble with the Standards Committee. So look, Arif, it's always a pleasure to see you. Thank you for your presentation. We should meet up one day and have a coffee.
Will do.
But brilliant. Thank you very much.
Thank you.
We're going to let you go because you're a busy man and you've got to get on to the next presentation. Once again, thank you for taking out that time. Please come back and tell us when there's an update on this fiasco that's going on. And to all, if you're affected, get in touch with our FC if he can help you out. That's it. And I think I'm nearly out of 50p's, but I'll have some more for next week. Got a super special guest, similar subject, second view. Again, this subject is going to run for a bit, I think. Arif, we look forward to seeing you, and let's do that coffee, buddy.
Thank you. Thanks.
All right. Thank you very much. Now I'm going to work out how to turn this thing off. It's amazing, isn't it? Yeah. Arif, let's get to